Attention, something just shifted in the XRP market, and almost nobody is reacting the way they should. Right now, while most people are distracted by short-term noise, a quiet pattern is forming, and it doesn't behave like a normal crypto cycle. The price isn't exploding, headlines aren't screaming, and yet, beneath the surface, activity is building in a way that feels calculated, almost controlled, and that raises a question most investors aren't asking yet. Because when markets move silently instead of loudly, it usually means one thing: the real move hasn't started. And that's exactly where things start to get uncomfortable. Because if this is true, then the majority of people waiting for confirmation might already be too late. Now here's where it gets even more interesting. Some investors aren't waiting anymore. They're not chasing hype, they're not reacting emotionally, and they're definitely not announcing their moves publicly. Instead, they're quietly increasing exposure step by step as if they're seeing something others don't. But why would anyone accumulate an asset that hasn't proven itself yet in this cycle? That's the contradiction that creates tension, because logically, people wait for momentum. But strategically, smart money often moves before it becomes obvious. And this is where the first crack in the narrative appears. Because the story you're hearing about XRP right now might be incomplete, not necessarily wrong, just missing a key piece that changes how everything should be interpreted. There's a difference between what the market shows you and what it's preparing for. And if you don't understand that difference, you end up reacting instead of positioning, which is exactly how most people get left behind. So the real question isn't whether XRP will move. It's whether this quiet phase is actually the setup before something much bigger. And if that's even partially true, then the next thing you're about to see might completely change how you look at this entire market. Listen carefully, because the signal that could change everything isn't loud. It's subtle. And that's exactly why most people miss it. Over the past phase of the market, attention has been locked onto price action. But price is often the last thing to move, not the first. What moves first is positioning, behavior, and structure. And right now, those three elements are shifting in a way that doesn't match the public narrative. Here's the uncomfortable truth. While headlines keep framing uncertainty, the underlying environment around XRP has been quietly stabilizing. Not perfectly, not instantly, but enough to create a foundation that didn't exist before. And that difference matters more than most people realize. But here's where skepticism kicks in, and it should. Because every cycle, there's always a story that sounds convincing, a setup that looks promising, and a crowd that believes this time is different. And many times they're wrong. So what makes this situation different, or does it? That's the tension you need to hold on to, because blindly believing either side is exactly how investors lose clarity. Now here's the part that doesn't get discussed enough: the gap between perception and behavior. Public sentiment around XRP still carries hesitation, doubt, even fatigue. But behavior in certain segments of the market doesn't fully match that hesitation. And when sentiment and behavior start to diverge, something is usually brewing beneath the surface. It doesn't guarantee an outcome, but it signals that the current narrative might not reflect the full picture. At the same time, critics argue that XRP's momentum is overstated, that regulatory shadows, competition, and slow adoption could limit any real breakout. And to be fair, that argument isn't baseless. But here's where it becomes interesting. Because markets don't move based on certainty, they move based on shifts in probability. And even a small shift, if misunderstood by the majority, can create an outsized reaction later. So the real question isn't whether XRP is good or bad, it's whether the current signal is being interpreted correctly. Because if it's not, then what looks like hesitation today might actually be quiet positioning for something much bigger tomorrow. Breaking. The number everyone wants to hear isn't the most important part. The logic behind it is. Because throwing out a price target without a framework is just noise. And in crypto, noise is everywhere. What actually matters is understanding how a price could move, why it would move, and under what conditions that movement becomes realistic. So instead of jumping straight to a number, let's start with structure. Because XRP doesn't behave exactly like most assets in this market. Its price history isn't purely hype-driven, and its cycles have often lagged, compressed, or reacted differently compared to the broader crypto space. Now here's where patterns begin to emerge. Previous cycles show that XRP tends to move aggressively, but only after long periods of suppression or stagnation. And when those moves happen, they're not gradual. They're explosive, often catching late entrants completely off guard. But here's the catch. Past performance creates expectation, not certainty. Just because something happened before doesn't mean it will repeat the same way. and that's exactly where most predictions fall apart. So what would need to align for a major move to even become possible? First, market-wide momentum, because XRP rarely moves in isolation. Second, clarity around its ecosystem, whether legal, institutional, or structural. And third, timing, because even strong assets fail when timing is wrong. Now, based on this framework, not hype, not emotion, a realistic projection starts to take shape. Conservative scenarios suggest moderate upside if conditions only partially align, but if multiple factors converge at the same time, the range expands significantly, and this is where things get controversial, because some projections push XRP into levels that sound unrealistic to the average investor. Not impossible, but highly dependent on conditions most people aren't factoring in. On the other side, skeptics argue that even reaching previous highs could be a challenge, pointing to competition and shifting market dynamics. And again, that perspective isn't irrational. It's grounded in caution. So now you're stuck between two narratives, one that sees explosive potential and one that sees limited upside. And the truth? It's not about choosing a side blindly. It's about understanding what would validate either outcome. Because once you understand the conditions, the price target stops being a guess and starts becoming a probability. And that leads to the next layer of this story. Because if these conditions are even partially forming, then the behavior of a very specific group becomes impossible to ignore. Listen carefully, because this is where the narrative shifts from speculation to behavior, and behavior is much harder to fake. Retail investors usually react to price, but institutions position before price becomes obvious. They don't chase momentum, they build exposure during uncertainty, and that difference alone explains why most people enter too late and exit too early. Now here's where XRP enters a very specific conversation, because its long-standing narrative has always been tied, directly or indirectly, to financial infrastructure. Not hype cycles, not memes, but systems that move value at scale. And whether you believe that vision or not, it changes how you interpret its potential. And this is where opinions start to collide, because some analysts argue that XRP is uniquely positioned for institutional relevance, while others claim that narrative has been exaggerated for years without meaningful follow-through. Both sides have evidence, and that's exactly why this becomes a battleground of interpretation. But here's something that often gets overlooked. Institutions don't announce intent early. They test, they explore, they build quietly. And only when conditions align do they scale aggressively. So when people ask, are institutions already in? They're usually asking the wrong question. The better question is, are institutions preparing? Because preparation leaves subtle traces long before full commitment becomes visible. And this is where things become difficult to read, because those traces are rarely obvious. They show up in patterns, partnerships, infrastructure discussions, not necessarily in explosive price action. At the same time, skepticism remains valid, because not every institutional narrative turns into real adoption. Markets have a history of overestimating timelines, and XRP is no exception to that criticism. So now you're balancing two realities, one where institutions could eventually amplify XRP's relevance, and another where expectations might be running ahead of reality. And navigating that tension is where strategic thinking matters most. Because if institutions do move decisively, they won't wait for retail confirmation, and by the time it becomes obvious, the opportunity window could already be closing. And that raises a critical question most people aren't prepared to answer yet. What if the real risk isn't being wrong about XRP, but being late to something that was quietly building all along? Breaking. Every opportunity that looks this compelling carries a risk most people prefer to ignore, and XRP is no exception, because beneath all the optimism, there's a layer of uncertainty that doesn't disappear just because the narrative sounds strong, and ignoring that layer doesn't make you confident, it makes you exposed. The first risk is time, and it's the one that quietly breaks most investors. Even if the long-term thesis is correct, delays can stretch far beyond expectations, and in a fast-moving market, patience isn't just difficult, it's expensive. Then comes competition, because XRP isn't operating in a vacuum. Other networks, other technologies, and other solutions are evolving at the same time, and assuming XRP automatically wins that race is a conclusion, not a guarantee. Now here's where it gets uncomfortable, because regulation, which many see as a potential catalyst, can also act as a constraint. Clarity doesn't always mean advantage. Sometimes it means limitation, structure, or conditions that slow things down. And yet, despite all of this, some investors continue accumulating, and not cautiously, but with clear intent. That contradiction forces a deeper question. Are they overlooking the risks, or have they already priced them in? Because experienced participants don't ignore risk. They position around it. They assume delays, they factor in competition, and they prepare for uncertainty. But they still move forward if the potential reward justifies it. At the same time, critics argue that this mindset can become dangerous, that conviction can turn into bias, and bias can blind investors to changing realities. And that's not just theory. It's happened in every cycle. So now you're facing a real dilemma, not a theoretical one. Do you wait for full clarity and risk missing the move? Or act early and accept uncertainty as part of the equation? Because there is no perfect moment, only trade-offs. And understanding those trade-offs is what separates calculated positioning from emotional decision-making. And this leads to the final piece of the puzzle. Because once you understand both the opportunity and the risk, the only thing left is strategy.